Hi everyone, CJ here. Happy New Year. Hope you had a great holidays with the family and friends as well as a strong start to 2025. Welcome to the Financial Rundown, a new monthly podcast we are planning for 2025 where I share the key financial updates and insights you need this month. We'll start with some quick practical tips to help you stay on top of deadlines and opportunities. And then we'll dive into some bigger topics about the markets and economy to give you a clearer picture of what's going on and, more importantly, what it means for you. Let's get started. Some timely financial updates, tax-free savings account, and first home savings account contribution room. So as we enter the new year, TFSA and first home savings account contribution room are at the forefront. As of January 1st, your TFSA contribution room is increased by $7,000 for 2025. And your first home savings account contribution room also increased by $8,000. Let's talk a little bit more about why a TFSA should matter to you. TFSA's tax-free savings accounts, they allow Canadians to grow their savings and investments tax-free, hence the name. It accumulates yearly and withdrawals are tax-free, making it one of the most versatile financial tools. A common misconception and maybe a bit of an incoming rant here, calling it a savings account is a bit misleading, as I like to think of it more as an investment account. Investing your funds within your tax-free savings account allows for more opportunity to take advantage of the actual tax-free growth benefits. Many clients also ask, what interest rate can I make in my TFSA? Well, that really depends on how you want to invest the money within your account. Because it's key to remember that TFSAs can hold various investments within your tax-free savings account, including stocks, ETFs, bonds, mutual funds, GICs, and cash. So think of the TFSA as a house, and there's different rooms in the house. You can have different holdings within the TFSA, and those are your stocks, ETFs, bonds, funds, GICs, and cash. So whether you're saving for short-term goals, an emergency fund, and or long-term growth, retirement planning, or for a major expense in the future, tax-free savings accounts are a great way to put money aside and or invest it to grow for the future. We want to make sure that our clients are not leaving this opportunity for growth on the table. Let's talk about why a first home savings account, or FHSA, should matter to you. Generally, it's only going to matter to you if you're buying your first home or if you're helping out family to buy their first home. FHSA's first home savings accounts are a relatively new tool designed to help Canadians save for their first home. Again, hence the name. Contributions are tax deductible, similar to an RRSP, but withdrawals for a qualifying home purchase are tax-free, like a TFSA. So think of an FHSA as a hybrid account combining the tax benefits of RSPs and TFSAs, specifically tailored, though, for first-time home buyers. Contribution limits are $8,000 annually with a lifetime of $40,000. Unused room carries forward, but only up to the annual maximum. So you can only go back 1 year at a time. So the maximum you can do is $16,000 in 1 year. You can't all of a sudden open one up and throw $40,000 in there to catch back up on those previous years. So those are some intricacies to keep in mind and to ask questions about. FHSAs can hold various investments, including stocks, ETF, bonds, mutual funds, GICs, and cash. FHSAs are a near must-have for first-time homebuyers. Jerry and I have discussed this on the podcast before. Certainly relevant for anyone planning to buy their first home within the next 15 years. What do we recommend to be the next steps? Well, we'd encourage you to get onto your CRA My Account access and check your available TFSA and FHSA room, or reach out to us to see if we can confirm your room and begin exploring some strategies for maximizing these accounts in your 2025 plan. Another very timely financial update is a meeting we do every year, the 2024 Income Review and Tax Planning meeting. It's a major part of our business, and our focus here is to review your total income for 2024. This is absolutely crucial for tax planning, especially with some key deadlines approaching. They've been the same forever, but a reminder never hurts. So RRSP contributions to reduce your taxable income are due before February 29th. And your tax filing deadlines are in March and April, depending on your filing situation. So why does this matter to you? Well, I personally think this is the most important time of the year to be looking at your finances and reviewing your plan. This is going to be a common theme of our conversation today, but a proactive review ensures you take full advantage of tax deductions and, maybe more importantly, avoid surprises. Many Canadians leave money on the table by not planning ahead. So reach out so we can discuss your last year's income and we can create a tax strategy that works for you and avoid that feeling of filing your taxes and going, oh, you owe some money and that surprise there. Let's try to plan to avoid that. Changing lanes here, let's discuss a few recent market and economic insights. Our first topic is the January Barometer. What better time to talk about the January Barometer than January? The January Barometer is a historical trend suggesting that the stock market's performance in January can predict the overall direction of the market for the rest of the year. So goes January, so goes the year, is a popular Wall Street adage widely used by investors. But does the January Barometer, does it hold any weight statistically? Jeffrey Hirsch, he's the author of the Stock Traders Almanac, which we get shipped to our office every year. I think he does the best work on the topic. So Hirsch states, I'm going to read this here. The S&P gains in January's first 5 days preceded full year gains 83% of the time. 14 of the last 18 post-presidential election years followed the first 5 days direction. So that January is seemingly key looking at that. And although while it's not a guarantee, of course, some data points to the correlation between a positive January and positive full year returns in markets like the S&P 500. The concept is really rooted in investor psychology and early year activity. So as we've been discussing, a lot of new contribution room becomes available in the new year to your accounts like tax-free savings, RRSP account, first home savings, etc. And sometimes you might get that year-end bonus gets paid in January. So there's some portfolio rebalancing. The new contributions can pump the market up in January. I'd be remiss if I didn't clarify, though, because I think Jerry'd have my head if I didn't clarify here. The unavoidable fact is that the market's near-term movements are largely unpredictable, even over periods as long as a year. Why I think this is relevant to you is the January Barometer offers an opportunity to review your portfolios early in the year and consider if adjustments are needed. January's performance can set the tone for broader trends for the year, making it a good time to revisit your pillars of your financial plan, your investment goals, allocation, and risk tolerance. So especially if you're going to contribute funds this year, January, we can discuss strategies like dollar cost averaging. And if you've been a client for long enough, you know we don't time the market here. But starting early provides more time for growth and helps take advantage of the magic and power of compound interest. If you're thinking about adding to your investments, we can discuss how to approach it strategically, making sure your money is going to the right account and the right investment. Post-presidential election year trends, a bit of a mouthful, but certainly topical with the latest news we have had here in Canada with Trudeau stepping down. I'm sure there's going to be lots more news on that coming out over the next few months and new leaders and election this year in Canada. But in the U.S., which I want to focus on right now, in the U.S., Donald Trump was elected in November. And the post-presidential election years have a well-documented impact on the economy and the stock market due to the policy shifts, economic plans, and regulatory changes that often accompany a new administration. These effects tend to influence investors' feelings and, of course, market performance in the years following an election. I was looking at some data. Historically, post-presidential election years have been the weakest of the 4-year cycle. And data from the Stock Traders Almanac, which tracks the market performance all the way back to 1833, which I didn't even know they still had data for 1833, but this shows these years often bring lower returns and higher uncertainty, transition of power policy changes, and the market adjusting to the new administration's priorities. However, the good news, we're positive here. The glass half full look is post-World War II data tells a different story. So when we analyze the past 10 post-presidential election years going back to World War II, 8 have been positive, with only 2 showing negative returns. So this shift suggests a more stable economic environment in modern times and improved investor confidence. And it feels a little bit, I'm not sure if ironic is the right word here, that with all the craziness we've had over the last 5 years or so, but certainly the market's been resilient there. And why are we talking about this? Why do I think it's relevant for you? Because as we begin 2025, it's again, great time to reflect on your financial strategy. New year, new start, and with new contribution room available, it's a fresh year to build wealth and continue building wealth. And so now's the time to evaluate your plan. I think it's a good time to reset expectations for the market as well. Market patterns from previous post-election years suggests we could see some volatility, particularly in quarter 1 and quarter 3. While 2024 has been a great year for returns, it was a historically low volatility in 2024, and 2025 may return to more average levels characterized by, what does that mean? Periods of drawdowns and recoveries. And I think this normalization of market activity is expected, and understanding this context can help you stay the course without overreacting to short-term movements. And that's what we're here for. Have those conversations and ensure that your investments are aligned with your goals. That's always the key focus, is the long-term plan. Regardless of the annual trends, the most critical element of your investment strategy is maintaining a long-term perspective. If your personal goals or financial situation have shifted and you find yourself taking a shorter-term view, it's 100% worth revisiting your allocations. We have to look at that, your allocations and your risk tolerance, your investments. I can't stress that enough. Adjustments might be needed to align with your new objectives, particularly if you're anticipating life changes or a need for liquidity or cash in the near term. As always, when we're talking about historical performance, there's our favorite disclaimer. And while past trends provide valuable insight, it is important to note that historical performance is not a guarantee of future results. Every market cycle is influenced by unique factors, and 2025 will bring its own set of challenges and opportunities. Now I would like to talk about how the Canadian dollar is doing compared to the US dollar. You may have seen the Canadian dollar has been weakening over the last few months. It's at its lowest level since the pandemic, and with forecasts suggesting it may drop even further over the next few months. It's below 70 cents now, could drop a bit more there. And there are, of course, several reasons and potential reasons for the decline, but I wanted to highlight a couple here in this conversation and focus on one. But the first one, the economic divergence between Canada and the U.S. So what does that mean? Canada's slower GDP growth, higher unemployment, and higher debt-to-income ratio compared to the U.S. Is one of the reasons the Canadian dollar is weakening. But I think more importantly, the downturn over the last couple of months, I feel is mainly more to do with the U.S. has been cutting rates as well as Canada, but less aggressively than Canada, which makes American investments more attractive. So Canada, when you hear the Bank of Canada cut rates when they do their press conference, and the U.S. does the same thing. Jerome Powell down in the States, the U.S. Fed chair, they just have not been cutting as fast or as much as Canada has. So that's created this interest rate gap between the two, which makes America more attractive for investments because the rates are still a bit higher. And I think the outlook for that, Canada still has the potential to cut rates a few more times this year, whereas the sentiment in the U.S. is that they're maybe pausing on cutting rates and going to let things play out a little bit further. So I think that's a key thing to watch, that relationship when it comes to the currency exchange fluctuations between the Canadian and U.S. dollar. Why are we talking to you about this right now? Well, obviously, you may be feeling it. The everyday impact is Canadians are paying more for U.S. travel. So we have a lot of clients that go down to the U.S. for snowbirds or go down for vacation, and those costs are going up. It's costing more Canadian dollars to cover that U.S. bill. So you may be feeling that right now if you do travel down to the U.S. As well on goods that we import to Canada from the U.S., like food and tech, they're a higher cost, and it potentially is creeping inflation higher, which is a concern. As I said, it means it takes more Canadian dollars to buy the same amount of US dollars, which increases the cost of these imported items, which can cause inflation and prompt the Bank of Canada to raise interest rates to stabilize the currency and fight inflation again. So inflation is certainly one of those things nobody wants to see again. Nobody wants to probably even hear that word again. That's certainly one of the things we're watching, and one of the concerns is if the US pauses interest rate cuts and Canada continues to cut, the weakening of that Canadian dollar could cause a rise of inflation. Moving past the inflation side of things, looking at it now from the investment angle, and for our clients that are holding funds or ETFs that have US stocks in them, when the Canadian dollar weakens, the US dollar becomes stronger in comparison. This means the value of your US stocks that could be within your funds, as I said, or ETFs, when they're converted back to Canadian dollars, the market value increases. So generally speaking, holding US stocks, it acts as a hedge against a weakening Canadian dollar. So it's good when the Canadian dollar is weakening. But of course, that's a double-edged sword and a longer conversation for another day. There's certainly some thought to putting a plan together to sort of hedge those risks and make sure you have a good plan in place to keep more money in your pocket at the end of the day. So to end on an unrelated to finance note, I wanted to finish with a few shout outs and recommendation. On a serious note, the fires in LA are just devastating. Watching the footage and seeing how fast people had to leave their homes and belongings, absolutely heartbreaking. I see the stories coming out of insurance being unavailable for a lot of the homes that were damaged. And it made me start to think, what happens to the housing market when insurance isn't available? Food for thought there. On a lighter note, if you know me, I've been blessed with a few opportunities to visit the hallowed grounds of the University of Notre Dame to see the Fighting Irish football team play. They've had a great season, and they're back in the national championship game. They knocked out Indiana, Georgia, and Penn State, which has been exciting and fun to watch. So hopefully good luck and a good game in the national championship game there. A few recommendations I have. A book that I recently read, Same as Ever. Check it out. By no means a finance book. The author, Morgan Housel, he discusses human behavior, history, and decision-making, and the way he connects lessons from the past to challenges of today is really interesting. And it goes along with some of the themes of our discussions today. The world changes, however, certain truths about human nature remain constant. And probably on a less serious note here, my wife Jess and we did watch the latest season of Squid Games. It's always interesting watching a dubbed over show. I have to say it was a bit underwhelming. I didn't like it as much as season 1. Let me know what podcasts you guys are listening to, books you're reading, shows and movies. I'm curious to know, and all the best for a happy and healthy 2025.